All right. Well, thank you everyone for joining us. Just a couple housekeeping notes kind of before we get fully started today. We are going to take questions today via the chat window throughout the presentation, and then at the end of the presentation, I'll go ahead then and ask those to Dina. So we have heard that some folks are experiencing some slow internet connections across the state today. So if you would like to turn your video off, you're certainly welcome to do that to kind of save some bandwidth space, but that's kind of up to you in terms of whether or not you want us to see you. And then one other housekeeping note here is just a reminder about our upcoming next month's sessions before we talk about today. If you haven't already marked your calendar, May 6th will be our May edition of our small business webinar series. And we're going to have one of my colleagues, Tara Mastel, who's our community development program leader and does a lot of work with leadership development specifically. And she's going to be talking again on May 6th is when she's going to be talking. And she's going to be talking about some generational differences coming up between different generations you might have working in the workplace and how to kind of get them to work a little bit better together. So mark your calendar for May 6th. And again, that's a Thursday. It'll be at 11 a.m. There as well. With that, let me go ahead and introduce today's presenter, which is going to be Dina Johnson, who's a Montanan, who's currently working for Payne West Insurance and has a lot of expertise, but it's not the only thing she's done in her career. So she's got some small business experience as well from kind of the management and running side of things there too. So I think she's going to have some really great information coming at us both from her current professional status, but also from some of the life experiences she's had that led her to this point in her career. So with that, Dina, I'm going to go ahead and turn it over to you.
Thank you, Joel and Jason, for having me today, and everyone for taking time out of this warm Montana day to be on a webinar. I'm excited to be here. I've had the privilege of working with many of you over the years in different ways, as Joel mentioned in my past role with economic development, business consulting. I'm also a recovering banker, where that is had as well. And I'm really excited now to be working in commercial insurance, continuity planning, risk management with Payne West. So when Jason invited me, I was said, absolutely. We have some limited time today and we could cover this topic in depth for several weeks. So first I'm going to do is get onto the agenda and let you know exactly what we will cover today. As soon as I get to the right screen here, let's change my slides. There we go. Essentially, we're going to talk about 3 types of risk and the 5 risk management strategies. It's a 40,000-foot view, and like I said, we could spend all day, but this is really where the focus will be, and primarily as a precursor for a series that Jason's team intends to do going forward. I am going to turn my camera off. As Joel mentioned, that we had a little bit of connectivity issues earlier when we were testing, and feel free to do that as well if you need to. So go ahead and do that here.
And Dina, your camera's off, but I'm also not hearing you.
Oh, I'm sorry about that. Can you hear me now?
Yes, now you're back.
All right. My apologies. Feel free to tell me if you can't hear me. Thank you for that. The risk of doing a presentation via technology, right? On topic with our call today. Alrighty, so to get things started here, I'm all for embarrassing myself, so why not out of the gate do so? That is me there at the top of Red Lodge Mountain. Do I have any fellow skiers out there? I grew up in Red Lodge, so that was essentially my daycare. And I am 4 years old. And what I want to point out is that when I look at this picture now, all I can think of is, where is my helmet? My dad would tell me, be careful out there, he would say, and then I would go all day long, all over the mountain with my best friend. It's interesting though, because those words would ring in the back of my mind, be careful out there. Should I go through the trees? There's an unmarked trail. And well, sometimes, yes, I would. But essentially what he was doing was telling me, don't go ski. He wasn't telling me not to go ski. He was saying, manage the risk. I would, if I could ask him today where my helmet was, I would also do that, because that to me would be the next best thing besides being careful out there. Today, we're going to talk a little bit about what does it mean to manage risk, and hopefully at the end you'll understand what be careful out there can mean for your company. All right, so very fundamental, but I think it's important to start at the beginning and define risk. So I want you to pause as we read this together. The chance of loss or gain is risk. Now, most of the time when we're thinking about risk, we're thinking about what are the things that could go wrong. And as a growing company, you have so much coming at you thinking about what could possibly go wrong in the day. My employees might not show up. My supplier might not show up. What other things could be happening? It's not often that you wake up and say, what is the gain? I was talking with a business owner yesterday, and she sent me a text to tell me that she was up 300% her sales year over year from last year. She was so excited and just wanted to share with someone. And I talked to her in the very beginning when she first started her business, and I can tell you that a lot of the conversations surrounded around the gain. What am I going to do to build my company? How am I going to garner results and grow? And from day one, she wasn't thinking about how am I going to pay myself. She was thinking about where she is today and what that gain would be. By managing risk, which we're going to talk about today, and the things that could potentially cause a loss, you're also managing the ways that you can gain. All right, so there's a lot on this slide. What I want you to see is that there are three types of risk, and we're going to talk about each three. There's business risk, there's strategic risk, and there's hazard risk. Now, most of the time, the insurance industry focuses on traditional insurance for hazard risk. Traditional insurance programs, that's essentially your property and casualty, things that are the quick go-to. Now, we're really not going to talk too much about this today, and you might be thinking, why would an insurance broker want to not talk about traditional insurance products or hazard risk? And hopefully by the end of this call, you'll understand that as well. All right, so hazard risk. Look at the photo here. We're all Montanans spread across the state. And I would imagine there's not one of us on the call that didn't know about this tragic fire that happened in Gardner that impacted this community, this business, individuals. Essentially, a hazard risk is any cause that creates harm or damage to humans, property, or the environment. This is very simple. We all know this. But in terms of thinking about what are the types of risk, it's important to separate risk as we think about how we manage it. All right, business risk. We're going to talk a lot about business risk today. You're living this every day, no matter what your position, whether you're an owner of a company, an executive of an organization, a business leader, a consultant, a professional working in higher ed, an educator. We're all thinking about business risk, how risk is associated with the internal day-to-day operations of the organization. These are the risks that come up all the time. Most recently, we are hearing a lot more about cyber. You can see the picture in the top corner there of the bad actor, we're calling them, leaned over the computer. These threats are dynamic and sophisticated. In a recent survey by Gallup, 82% of business owners said the #1 concern they have currently is cyber. Not the pandemic, not international trade challenges, not supply chain, although we're going to talk about that too, not employees, workforce. The #1 threat to them, 82%, is cyber threats. And you might be asking yourself why, or you might be thinking, I absolutely understand that. In part, I think this is an emerging challenge that has been around for a long time. What's newer is the implications for small to medium-sized companies. The number of occurrences hitting these types of companies is growing. You used to hear about it in the news, larger companies, which we still do, but far more often, this is a hit on smaller businesses. All right. Has anyone ever had an employee who had a work-related injury? Maybe you yourself have had a work-related injury. the total cost to your business is with workers being out far exceeds what the insurance coverage would cover for a claim. The coverage is there, workman's comp, it pays for the injury, some medical expenses, potential in being out of work for that employee. But what's the cost to you if this happens? Well, we always think about rates, right? Your insurance premium costs are, how's it going to impact your EMOD? That's likely going up. Are my rates going to go up? I've heard business owners say, I don't even want to turn in a small claim. I just want to pay for it. That's another subject in and of itself. But as you can see, the implications of having an injury with the business risk are high. In terms of managing this risk, we're going to talk today about what you can do. 84% of our insureds have told us they have a written safety plan. The percentage is a lot lower of those that update those plans and follow it. A safety plan is effective if used. Many times construction industry and these types of industries have to have this, but what about your business? What's a safety plan look like for your company? Business risk and supply chain. This is another area that can have a significant implication on your business. Losing a supplier, gaining a supplier, all around the board. There can be gains and there can be losses depending on what it is. How do you quantify this and what's your plan? Pausing here again, contingency planning, business risk. Many of us understand the importance of disaster planning. And until the last year, a lot of this was centered around things like a tornado or a hurricane or a massive storm. And now the mindset is a little bit different. Did you have a plan before the pandemic? Do you have one now? Do you have more than one type? I want you to think about that as we continue to go through today. And just like that, everything changed. A lot of presentations focus on COVID and what's happened in the pandemic. And we're not going to talk about that in depth today. Everyone's in a little bit different place. But what we typically all can agree on is that everything changed. Is there anything we could have done to avoid this risk? When it happened, this was all about stabilizing. What can we control? How do we stabilize? And how do we move forward? Next, strategic risk. Strategic risks are powerful for organizations. Decisions that fit this bucket are the innovation drivers, and there also can be the tankers of a company. What are your goals? Do you have planned growth? Is it rapid growth? Are you going to buy equipment, expand, diversify your market, maybe new suppliers, increase revenue, cut expenses? That's everyone's goal. Maybe you anticipate a large loss. How will you absorb this? Oftentimes, as things fly at us, we're managing them as they come. Or maybe even at the beginning of the year, it looked very differently than how it looks now. Your projections at January 1 are suddenly completely different in March because something happens. What's the plan? Decisions made every day by yourself, managers, executives, owners, that affect the organization's ability to reach your goals and objectives. Does your entire team know what those objectives are? I asked the question of insureds, which is more likely, your building burns down or your management team is not cohesive. They don't have a clear plan. They're not strategically or tactically managing the business, resulting in turnover. Does this happen? Have you seen this happen? What plans can you put in place in terms of managing this risk to prevent it from happening? This might be my absolute favorite slide. A culture of growth, retention, and recruitment. You'll see in the picture there, it's not one individual that's growing to the top to reach their goals. It's the team all working together. All the hands in the middle working towards one common goal. In a culture of growth, There's so many different pieces of strategy that surround that, but at the end of the day, it's people. What is your first line of defense and your key to growth? The answer is the same. It's your people. 84% of businesses surveyed told us that their salaries and wages were their biggest expense. What they didn't know is what the return on investment for that expense was and how it was enabling them to achieve their goals. Human capital is your number one asset. It's also your number one liability. And we talk about a risk plan and investing in people and building out what those potential exposures could be. You won't be sorry for spending time on that. What does it feel like to work in your company? And how do you know? Are you living out those core values? Does your company have a culture of growth? And there's a lot of different things around the word culture these days. But as you think about building out your plan, ask yourself, do we have a culture of growth? We're growth-minded companies, which is what today is all about, risk management for growth-minded companies. If you don't have a culture of growth, how can you possibly grow? Strategic risk. This is the fun one. If you're the right brain, left brain blend. What do your financials say? Are you growing? Are you digesting growth in a healthy way? Are you losing ground potentially? Can you access the best financing terms to achieve your goals? This is a strategic risk. Do you have plenty of cash on the balance sheet to purchase new equipment? Should you use that cash or should you finance it? Long-term strategy. If you purchased 5 pieces of new equipment right before the shutdown and had no idea that was going to happen, what would be the implications or the if you had switched that around and financed that differently and kept your cash? No one can really say at this point. This is an illustration, but it gets the juices flowing. If you want to add 3 buildings, 10 pieces of equipment, 20 employees in the next 3 years, what needs to be true today to make that be possible? And what is the most strategic approach to go after that? Strategic risk and succession planning. Oftentimes, this is about an exit strategy when we think of succession planning in terms of a business or a company. Not too often do we think about succession planning for key positions or key employees. If you asked yourself the cost of turnover of a key employee tomorrow, what is your plan? Can you quantify that? Do you have a bench in place to be able to move people into those key positions? What if it's yourself? What does that look like? And how are you strategically protecting yourself? We've talked about the types of risk. Now we understand the types at a 40,000-foot view as time allows today, but it's important to spend time to identify, prioritize, and quantify the risks. So we have 3 types, and now we're saying, okay, now what? Quantification is basically analyzing your risks. In the picture here, you can see they're essentially broken into quadrants, evaluating the different types: low risk, medium risk, high risk, and how does it impact the company? Can you rank your risks today? Maybe you've done this. If you have, that's great. When was the last time you looked at it? What types of risks can you list right now? There's a lot on this screen. I can tell you oftentimes in my discussions with business owners, I can start to circle the types of risks that they talk about when it's what keeps you up at night? What are the things that you're thinking about? What are the strategies for your company going forward? And I start to circle them, and before you know it, about half the page could literally be circled. I want to challenge you to take a look at these risks, ones that maybe you haven't thought about, and how that might fit into a strategic plan. Does your risk change? Has it changed? In the 90s, kiddos used to talk about back in the 60s, and now I'm learning that they're talking about back in the 90s. I don't know about you, but that makes me feel a little bit old. As you can see here, the construction industry has changed. The dynamics of the environment have changed. How we do business has changed. This is no secret. I'm not teaching you anything here today that you don't already know. thinking about it differently in terms of pausing and spending time to ask the real questions on what has changed. Has the business model changed? Have our suppliers changed? Have the problems of our consumers, our customers changed? What has changed in your company or organization? And how are you going about identifying what has changed? The next slide is a great example and tool that you can utilize with Jason and his team. Likely many of you are familiar with a SWOT analysis, essentially identifying your strengths, weaknesses, opportunities, and threats. Conducting a SWOT analysis is essentially a simple way to identify risks and opportunities. And as you heard earlier, risk is essentially the potential of a loss or gain. What better way to identify a potential loss or gain? Got a business owner client who decided he would make up his own board, his own advisory council, his banker, his insurance agent, CPA, attorney, employee, representative, top 2 customers, and then his managers. And they meet annually to conduct a SWOT analysis of him, his leadership, the management, their goals, to really do a gut check on everything they're doing and to essentially identify the risks. What is the potential for loss? What is the potential for gain? And what's our plan to go after a strategic way to approach it, ultimately to achieve our goals? Now, I told you we weren't going to talk a lot about insurance, and we're not, but it is important here to pause because right now we are in a harder firming market. And really, that is simple math. That means our premiums greater than losses. And as you know, there's been a lot of exposure, a lot of losses, hurricanes and hail and fires and all of the things that are happening in the market, cyber, that cause claims. And so what happens is carriers start to shrink capacity and pricing can start to go up. And that's a challenge. An insurance industry is a for-profit model. As you build out your risk plan, that risk plan can be used with your agent to go about presenting yourself the best possible way in the market to not only achieve the capacity that you need, but the best pricing that the market can offer. How we being the insurance industry, view risks in an insurance program. We look at the hazard risks and the business and strategic risks. And there are products that can help you with business and strategic, but nothing can help you more than a strategic risk plan and working hard to set goals and objectives. I keep throwing out the word risk management. I want you to look at this. Which photo resonates with you? I'd love to be the girl out on the ledge. I'd also love in a lightning storm to be under the bubble. Wouldn't we all? But at the end of today's presentation, I want you to think about there might be another answer to which one of these is the best risk management strategies. Could it be both? Or is there something a little bit different? So risk management defined. I don't normally put a lot of words on a slide, but I think this is important, so I'm going to go through it. Risk management is the identification, evaluation, and prioritization of risks, followed by coordinated and economical application of resources, so applying money, spending, what are you going to spend on it, to minimize, monitor, and control the probability or impact of unfortunate events, or to maximize the realization of opportunities. Notice how only the tiny last sentence is about the opportunity, which as entrepreneurs and business owners, isn't that the goal, is to maximize the realization of opportunity, to grow your customer base, to be more profitable, to expand, to achieve your goals. Yet the primary focus all around risk management seems to be about managing all of the things that might be able to go wrong. My argument is that they're both equally important. And if you manage the risk management side of identifying the risks, you can actually utilize those to your benefit to maximize the realization of opportunities. Everything we've talked about so far today fits essentially into a 5-step process. 5 strategies, and now we have 5 steps. Identify, assess and analyze, plan, your action plan, monitor and implement, measure and control. We're going to talk a little bit more as we go. Now you have it. I listed them on the full slide there. You can see those strategies. I want you to see how hazard risk, the traditional insurance model, goes down to talk about finance and transfer. Prevent, mitigate, assume, finance, transfer. Those are your 5 strategies. We're going to talk about them now. Look at this like a cycle. As we talk about the strategies, I want you to think about them like that. It's very possible that one or more strategies will be used. All right, I'm trying to make this interesting. I know it's a little bit dry, but bear with me. Thank you for staying tuned for insurance topics here. All right, so avoid. This is the first strategy for managing risk. And you might think avoid, how is that a risk management strategy? But it actually is. So you see here the number of spam calls that are coming through on the phone. I can avoid the call and the spammer simply by not answering the call. I can avoid it altogether by not having a phone. How can I learn from receiving the spam call? Maybe I can also avoid future by blocking the caller. Very simple, but you get the idea. Mitigate. We all know this picture all too well. Risk management isn't always about avoiding risk. It's about mitigation, doing the best we possibly can with the circumstances that we're given. How many of you love hiking? I'm a Montana girl, love to go hiking. I'm the one who has my first aid kit, my bear spray, my water, my best hiking boots, sunscreen, can't forget the sunscreen, power bar, umbrella. I'm ready to go. 2 power bars apparently. But who has the friend, and maybe you are the friend, who brings nothing? They bring the wrong, including the wrong shoe selection, no sunscreen, maybe they know you're gonna bring it. If you think about it, we're both managing risk, me and my friend. I'm mitigating, and he or she is assuming. They're saying, you know what? I might run into a bear. It's all going to be good. Risk, there's a lot of times within your company or other areas of life, whatever it be, where we simply assume risk. We pull out during Jenga, the block there, we know it could fall. We evaluate the risk, we identify what it is, and we're going to assume it. What's the worst that could happen? The tower could fall, I could lose the game, but I'm going to play anyway. There's other types of risks that you assume every day in your business. Going out and about, meeting people, going to functions. There's risk has a whole new identity in a way as things are opening back up and we're seeing across the country. What risks are you assuming? Should you be assuming them? What are the cost implications of assuming them? Can you quantify it? It sounds like a simple topic, but at the same time, this can have a huge implication on your business. Finance. Insurance does not avoid, prevent, or reduce risk, it pays for it. I'm going to say it again. Insurance does not avoid, prevent, or reduce risk, it pays for it. Finance is simply insurance to pay for it if something happens. This is important. It goes along with your risk management plan. It's not the most important. How does it pay for it? Here's an example of a cyber policy. What does it pay for? It doesn't prevent the bad actor from attacking your computer, getting into your files, encrypting your information, stealing your information. It simply pays for the forensic IT team, the legal team with the breach coach, and accounting assistance to quantify your loss and help you moving forward. I recently talked to an insured who talked about their backups and all the systems they have in place and the IT company that's taking care of their data. And while all this is awesome, this is a mitigation strategy. At the end of the day, combining those two is really the only way to protect yourself all the way around. And so it's important to have a good program in place and a good plan. All right, transfer. We're going to talk the least about this. This is the most important piece to talk to an attorney about and your agent. So specific, so many ways that we could go into this, but you can essentially transfer risk via contracts. For those of you already working in companies that do this, you know all too well that the language within a contract is critical. Make sure you do a contract review with your attorney and your insurance provider, understand what's expected of you, and understand what you're holding others accountable to. If you require insurance of your independent contractors or subs or whoever it is that you're working with, make sure that you get documentation. Records are a very important piece. Transfer is a risk management strategy. All right. We've talked about 3 of the 5 in the process of risk management. The next is monitor and implement. We're not going to cover too much in depth, as this is going to be a topic in a future series block that Jason's doing, but essentially monitor the plan. It shouldn't sit on a shelf collecting dust. Determine how often it needs to be monitored, not unlike reviewing your financials monthly, quarterly, annually for your planning and budgeting. You should be doing the same thing with your risk management plan. And they should really be working in conjunction. Implement changes in real time. Don't wait for when you're not busy. You're always going to be busy. And then measure and control. This sounds so simple, but what is your company mission, vision, and goals? Do you have them written down? Does everyone in your organization understand what they are? And then company policies and internal controls. We could teach an entire series. There are degrees that are offered in higher education on this. We're not going to go into that today, but essentially I would challenge you with a few questions. When you sit down to evaluate your plan and how you're measuring and controlling, ask some questions. What did the plan say we would do? What did we actually do? And then explain the difference. Did we do better, worse, why? And what are the consequences or opportunities of the difference? What happened to get us off track? And what did we learn, and how are we going to move forward? If you've had a claim related to an employment related work injury, the first thing that you're going to do after that is find out what happened, how did it happen, why, and start educating around that. That is not uncommon. That's not rocket science. Think about all the other types of risk that you have. And if you approach it in the same way that you're doing with something like that, you're going to find that you're not only going to be more strategic in managing your risk, but more successful and less likely to hit a roadblock to keep you from achieving your growth goals. There you have it, the basic overview of 5 strategies for managing risk. And at times, like we talked about, more than one strategy is used. Total cost of risk. Do you know what it is? Insurance premium and deductible is one tiny piece. Your business and strategic risks are the most significant portion. Each chart's going to look a little bit different for each company and each team. What I would challenge you to understand is, what am I actually paying for my total cost of risk? Not just your insurance premium and your deductible, which yes matters, but what are my retained losses? What am I spending on a strategic risk plan? Am I working with my agent? Different size companies are going to have different types of approaches, and you're going to have different types of costs, but from a percentage standpoint, I would go out on a limb and say your pie chart is going to look very similar. Savings. It's all about money. It's very important to us, right? Going to business, how am I going to be able to do the absolute best I can? Traditional insurance models are transactional, shopping the market, best price. Other models follow value added. What additional things can my provider give me? Loss control services, what have you. Business risk management is a whole nother level, and it's critical. And you should be working alongside your agent, your broker, your attorney, your CPA, your managers to build a risk management plan. And I can tell you the potential financial impact is significant. These services are available. Our team does have a whole risk management team dedicated to this. Their experience far exceeds that of what you would find in many traditional models. And they don't charge for that. They're taking care of their clients, because if your risk management plan is solid, then your business is solid and growing, which is what we want for our clients. Okay, so what is your plan? What story is your broker telling carriers on your behalf? And what story are you telling your customers, your suppliers? Hopefully it's somewhere in the middle as illustrated here. And depending on the day, it might be on the right or the left as well. A failure to plan is a plan to fail. Benjamin Franklin said that. You see that in a lot of business planning or strategic planning presentations. How many of you knew that who co-founded the first insurance company in 1752 was also Benjamin Franklin? I want to thank you for being here today for this 40,000 foot view. We didn't go super in depth, but hopefully there's something that you can take away. As a thank you, I'd love to meet with any of you individual to answer deeper questions. If you email me your goals for your risk management plan, or ask me a question in an email, not only am I going to send you a thank you gift card to a local Montana company, because I believe strongly in supporting our local Montana companies, but you might just make a new friend, and I'd love to meet you. I appreciate your time today. Joel's gonna field some questions, so thank you. And for me, be careful out there.
All right, well, thank you, Dina, for the presentation. We've got at least 3 questions to go through, and please feel free to continue to send questions in the chat window. So let me start with the first one that came in relatively early on in your talk, which is, what areas of risk do you have the hardest time convincing business owners exist that they're not currently addressing very well?
What areas of risk do I have the hardest time convincing business owners that they're not addressing? I wouldn't say that I work to convince. And Jason will probably has heard me say this before. A consultative approach is really listening and understanding problems from the business owner's perspective. And so oftentimes when you listen and have a thoughtful conversation, they'll typically self-identify what those challenges and risks are. I will take financials and spread them, look at trends, understand what's happening, and likely the things that are either keeping a business owner up at night or that they're struggling with will rise to the surface pretty quickly. So I wouldn't say that that has been a challenge. I think that we all can be our own worst enemies in terms of getting in the way of progress and focus. Kind of the mindset of, I'll worry about that tomorrow. That's not happening. Recently, I would say just in terms of cyber, because it is happening, I am hearing that doesn't happen to me. I'm not online. I don't really have a lot of exposure. I have backups. Backups are a big misnomer, because if you do receive a threat from a bad actor, essentially they're encrypting your software. So if you go onto your computer, you suddenly can't read anything and without paying for the encryption key. And so an option is to say, nope, I'm not going to pay for it. I have all backups. The challenge is, and the misnomer is that now that bad actor has all the information. So let's say it's customer payment information. If you have a POS system, they can now go sell that information on the black market. Just because you have your backups and can re-access your data doesn't mean they don't still have that and can go sell it. So now you're on the hook from a liability standpoint for regulatory and compliance issues related to paying for notification of every customer whose information was breached and or any fallout. So let's say the bad actor sells the information on the market and now somebody has experienced identity theft and they can circle that back to the breach for you. Well, you A, didn't have coverage, B, didn't notify the customer. So now you're at risk for several types of liability. I would say most recently that stands out because I've had that conversation several times in the last week. But overall, I wouldn't say my role is really to convince anyone about the risk they have. It's really to work alongside a client to better understand their risk exposure. Because typically the business owner is going to know their risk far more than I do. Does that answer that question?
I think so, and if not, they can follow up in the chat window and we'll dig deeper. So let's, next up here, you had talked about transferring some risk via contracts. How long is advisable for folks to retain contracts as part of a record retention policy?
So not an attorney, but I would say 7 years. past the point of when the contract expires is a good rule of thumb. However, it's unique to every situation in Montana. As you know, with construction industry, there's a 10-year look back period. So really that could vary. Consult your legal counsel. What is the contract for? A lot more involved in that. Certainly include your legal team and your agent as you look at it. Record retention, I'm a safety girl, so always steer on the side of caution.
All right, thanks. This question came in before. I think you addressed part of it, but I'm going to ask it anyways, and you might be just repeating a little bit. But is it true insurance companies work with businesses on risk management strategies? So I'm assuming they're beyond just selling an insurance policy. And if so, how do they charge for those type of services? And how do you get access to that kind of assistance from an insurance partner?
Yeah, that's a great question. So I can answer for Payne West. Every insurance company is a little bit different and unique in what they do and don't offer. Our risk management team provides those services at no cost to our insureds. We also offer that service to help with some volunteerism with Jason and his team and what have you. So you're not going to pay for to partner with either your broker, your agent, or our risk management team to put together those plans. Those plans make our insured stronger, better positioned not only to purchase insurance products, which is absolutely what we do, but to be more likely to be successful. More businesses go bankrupt because of strategic and business risk than they do for any other type. Good question.
All right, thank you. The last one that I've got that's come in is over the last year, what kind of new issues are business owners bringing to you with respect to risk management, maybe that they weren't quite as aware of before COVID?
Well, I think you said it there in that sentence, COVID, kind of becoming the four-letter word for everyone. I think continuity planning and tightening up. We've been very reactive to stabilize, and now with more forward thinking and growth, we've got a lot of companies that are actually growing. They're doing very well right now, and some of that honestly is out of what's happened. And so capacity, if you needed a $10 million excess policy before, it might be a little harder to get now. And so can I grow? Do I have the capacity to access the risk products that I'll need to be able to grow? Is top of mind, certainly for many.
All right, well, thank you. Now that's wrapped up all the questions we've got. Does anyone have any additional questions before we wrap up today? I'm seeing a thank you in the notes there.
Thank you, and thank you all. I know this can be a dry topic, but I can tell you if you want to spend some time on it, you'll enjoy it.
All right. Well, Dina, thank you very much for taking the time today to present. We will post a PDF version of the slides and the recording. So Dina's email address is there, and I know she made the offer that you could reach out to her with some follow-up things. So that's a great opportunity as well. And then for those of you that join us regularly, again, mark your calendars for May 6th. And Generations in the Workforce, Tara Mestel will be talking about getting those different folks to work together within your organizations. So with that, everybody, have a great day and enjoy the wonderful weather today.
Thanks, Joel. Thanks, Jason. Thanks, everybody.